Good morning, everybody. My name is Kyle Craig. I am the whole farm representative for the West Coast. I want to remind everyone that this meeting is being recorded, and also to please mute yourself and turn off your video cameras if they're on. We will be taking questions at the end of this presentation, so please hold them until then. I'll be giving this presentation in conjunction with Clacey Miller, who's the East Coast whole farm representative, as well as Mark Masters, who's our floating representative. This is our annual kind of comprehensive training that we do for whole farm. So as always, in the event that any of this material is incorrect or out of date, we've been updating this presentation, year after year. So this is kind of a comprehensive and cumulative training set of materials. In the event that there's any sort of contradiction or difference between what we're saying here and what you see in policy language, handbook language, those shall prevail. So here's a quick kind of overview of the agenda. I won't go into detail because this is a very long presentation. I don't want to dwell on details. General layout of time frame, how this presentation is going to go. We've had very few changes for 2026. Whole farm is a fluid and flexible program that does change year to year. This year we only had really a handful. They're pretty minor, so we will get into those. But we don't have the same sort of suite of updates that we normally do as we have had. They can be quite drastic from previous years. This is the NAU whole farm team. So depending upon the area you're working in and the branch office you deal with, these are the underwriters who generally work on whole farm and who will be working with you on policies that you're writing. So again, thank you for writing with NAU. We appreciate your business. Here's a brief summary of what NAU was doing in terms of whole farm business in 2025. 516 whole farm policies, which is about 26% of total whole farm, and 50% of microfarm policies running premium in the U.S. And so you can see the map of where we've got the most of those, both for whole farm liability and whole farm policies. And at the bottom of that table breaks out microfarm, whole farm in the United States. There is our now retired previous fearless leader, Dave Paul, working with apple farmers in the Pacific Northwest, and a brief history of whole farm, which began as AGR in Michigan. And then after Dave and the Spokane regional office had this listening session in the Northwest, due to the apple market, they set up pilot areas in Idaho, Oregon, and Washington in 1998. And whole farm has been growing ever since, and still the Northwest has probably the most significant amount of whole farm business and policy numbers, just in sheer raw numbers. Again, this is a little bit of a history where AGR began in the top left, and then AGR light in the bottom left, and then how it's all now become whole farm. Again, it's still a pilot technically, and as I noted, we see that some years where the language will change quite significantly, but it's the longest running pilot program. So the intention of whole farm is to ensure diverse farms with commodities without underlying NPCI. You can see this is an example of an actual whole farm policy that had 33 total crops with a pretty significant diversity discount, total premium, and most of these commodities had no NPCI available to them, so whole farm was a really good fit. So what is whole farm? Whole farm provides federally backed opportunities for risk management on commodities without underlying NPCI. Whole farms answer to traditional forms of federal crop insurance, it's the APH, which is the yield revenue report that you'll often be asked for. Whole farm requires 5 years of tax records to establish a benchmark for the farming operations average annual revenue earned. The whole farm history database consists of revenue history for the 5 consecutive tax years immediately preceding the lag year. There's exceptions, obviously, we'll talk about that. that result is compared to the insured's expected revenue for the policy year based on information on the farm operation report, and it covers all commodities produced or purchased for resale on the farm. It covers revenue earned during the policy year, whether realized or not, accrual accounting in the policy year. So bottom line, the approved revenue amount on which the coverage is based is the lower of the whole farm historic average revenue from the whole farm history report, which is based on taxes, or the insured's expected revenue from their farm operation report. This is a little flow chart kind of comparing how whole farm compares to NPCI, if you're more familiar with that, and how the intended farm operation report is in line with the intended acreage report, the revised farm operation report again with the acreage report, and then the final farm with the production report. So for a perennial, you don't have to. In the timeline, we'll get into the timelines of these for intended, revised, and final. But one of the things that you can note about whole farm is that, and a lot of people do this, if you're an operation that is growing exclusively perennials, then often those will be submitted, the I-4 and the R-4 will be submitted simultaneously at the sales closing date and not one after the other at R-4 time. So as I noted, we have very few changes for 2026, but we will touch on those a little bit. But first, if you're not familiar with whole farm, there's a lot of lingo associated with it, some of the commonly used terms, a lot of revenue approved. I won't read this entire list, but some of these words can get, if you're just doing whole farm for the first time, it can get a little bit confusing, but there are important distinctions when talking about the expected versus allowable revenue. That's kind of the tax history versus what you see on the farm operation report, etc. Again, more lingo and acronyms that you'll see. Just these are general crop insurance. Some of them are specific to whole farm, but these can get unwieldy sometimes. So instead of just talking about the 2026 changes, which I will get into, I also want to note some of the, if you haven't attended one of these or written a whole farm policy in a couple of years, some things have really changed dramatically. Specifically, producers with underlying CAT policies are now eligible. Historically, this made you ineligible. Lower the cost of the program by increasing the subsidy for single commodity producers from the basic unit to the enterprise unit premium subsidy. Increase the subsidy percentage on 75% to 80% coverage levels for single commodity whole farm policies. Now all eligible producers qualify for up to 90% coverage levels. That's one of the big changes. Whole farm policies now provides an option to opt out of all FCIC reinsured policies from becoming primary insurance for the purposes of premium calculations and claim settlement. 3-year average expected value changes. That was previously the price source of last resort. Now it can be used. RMA largely intends this to still be a niche pricing mechanism, but it is not anymore the price source of last resort. The base period to determine expected yields for commodities of underlying MPCI, it's now a 4-bill to 10-year database, similar to the APH. RMA revised the 180-day claim deferral for AIPs and moved the start date to the end of the insurance period. And they also, again, this is one of the things that happened this year, updated the beginning and veteran farmers and ranchers additional subsidy percentages. So also, and this is something that has been in place for a long time with potatoes, but for single commodity producers with revenue protection available for their commodity, only the revenue plans under the common crop insurance policy basis provisions and identified as revenue protection or revenue protection with harvest price exclusion in the actuarial documents will trigger ineligibility. So this means if there's another revenue plan available other than plans 2 and 3, a single commodity producer will now be eligible for whole farm. If the insured has a commodity count of 1 and the commodity has revenue plan 2 or 3, including wean calf program, and the insured is not eligible for whole farm. So again, we've seen that with potatoes for a long time. One of the things, want to reiterate here, if you're writing a policy and you're not sure about the commodity count, double check that. You want to make sure you're not submitting a packet. Run it through the quoter. We have fail safes in EasyWriter Pro that if you're a keying agent, that'll demonstrate, hey, this policy only has one commodity and it's ineligible. Pay close attention to that. So we do have a great set of checklists that all our underwriters use. We encourage agents to use when they're underwriting policies, kind of so that all expectations are aligned and you can be sure that as you're working through everything, everything's there. Those are posted on the agent portal on our website. Again, we always encourage agents to use our checklist to make sure you're sending us everything that we're looking for. We have updated our checklist for 2026 to streamline them a little bit more and make the language a bit clearer. Those should be up on the agent portal pretty quickly. We're working with IT to get those up there. As we've done, we require the agent to submit the full tax forms for the most recent year in the history period, for the first year for a new policy or transfer policy, or whenever a tax entity changes, so we can be sure the policies are set up with the correct entity name and the entire farm operation is covered. If a full tax packet has not been previously received, the entity been verified, it will be required to verify the correct entity is insured. We'll go into why this is the case, but basically, we perform entity verification to make sure that the taxes we received are for the actual entity that's filing the taxes and that the entire farm operation is captured in that policy. Remember to include any applicable tax statements for other income or other expenses, and also include 1099s if there are cooperative distributions noted in the taxes, and you're trying to include those as allowable revenue. For 1099s also, as a side, that's only 1099s related to the sale of insurable commodities, not fuel rebates or some other sort of co-op payment. Ensure that any additional support documentation to show income from sale is from the sales of the commodity. So a couple more reminders. Be sure the agent producer is the source of the expected yields and values are properly identified, supporting verifiable documentation is included. This is a big one for commodities without underlying APCI. A yield and revenue history report used to establish the 4 to 10-year history is required. Even if, and it's important to understand this, with the yield and revenue report, that is the certification process that the insured is doing to say, hey, this is what I've grown. This is my history. That's the certification yield and revenue history report. So even if you say, well, he's never grown it, so we're just going to use the replacement value for the NAP yield or whatever. You still have to submit a yield and revenue report for the certification for the farmer to say, I have never grown this, so we're going to use the replacement value. Hard copy of verifiable records must be available if requested to support what is certified on this form. Highlight this because this is, as I noted in the beginning, sometimes our information is not the most up-to-date on this particular presentation. We have had some conversations with agencies, done a little bit of closer reading of the policy and handbook language, and the language of the policy and handbook really requires the PAW as opposed to the specific underwriting report, the forage, grass seed, mint, etc. So we're requiring the PAW, and we're asking for the PAW instead of these specific reports. If you have underlying NPCI with the forage under report, the grass under report, mint under report, etc., that's a different circumstance. But if you are producing a perennial commodity that requires a perennial that has a underwriting report related to the planting date, the plant spacing, the density, the health, all that stuff, etc. We need the PAW, and largely I think that's because the PAW has that single question of, is there pre-existing damage? So this is old language. We're now asking for the PAW and not for these specific reports. For the vertically integrated producer form, it's still required for whole farm if the insured designates as a VIP. Market certification is not acceptable for whole farm. Be sure a beginning inventory form is complete for all insurers. If no beginning inventory, you got to note something on that, zero inventory, NA, whatever, but don't just leave it blank. Same thing for accounts receivable. If a substitute Schedule F is used for the lag year and the whole farm history period, a copy of the actual filed Schedule F or applicable tax forms should be sent to us as soon as the taxes are filed so we can update the information as necessary. That's for special circumstances regarding microfarm and beginning farmer rancher, where they're going to be using the lag year taxes. Commission schedule changes, we implemented these last year, but the highlighted text or the important part that we go through an initial determination of substantially complete for our applications that we received. The most part of the checklist, I'll go through the next slide. But if there's things that are missing from the application or incomplete, if we don't get those, we'll obviously request those immediately. If we don't get those within 25 days after sales closing day, there's going to be a 25% reduction in base commission. If they're not received after 60 days, you're going to get a 50% reduction in base commission. You can see our commission rates for whole farm, 17.52. So this is assuming that if the agent underwrites the whole farm and the underlying NPCI, that it's all written with NAU. If the agent writes with a different AIP, then that commission rate is paid differently. So we'll talk about how we track that in a minute. So as I noted, this is related to that commission question and this is related to that commission question. The top of all the checklists, and this is from our new checklist, we look the underwriter immediately upon receiving a packet within kind of 10 days of receiving it, he's going to go through this checklist to determine substantial completeness. And substantial complete, it basically means with required information to process. We're applying a generous interpretation of what this means. So, is the document there but missing significant amounts of key information? And so, you can see, is it there for number one, the whole farm app? The yes or no. Number two, for yield and revenue report form, for the that has to be there for each commodity underlying NPCI. If the policy has underlying NPCI for all or some commodities, then if it's with us, we can just pull it. If it's with another AIP, then we must receive that from the agent. That's one of the things that you have to send in. Number 4, number 5, the expected value yield document certification worksheet and the farm operation report, are they complete? Do they correspond to one another? 6 and 7, the whole farm 5-year or 1-year revenue worksheets and the whole farm history report, are they complete? Do they correspond with one another? Accounts receivable, market animal nursery report, and inventory report, are they complete? Do they have something on their NA? 0, etc. Signature page, is it timely signed? And then taxes. For substantial complete question, at minimum, did we receive a Schedule F, substitute Schedule F? That's different than the entity verification question. But in terms of the substantial complete determination, we're really we're trying to have a very generous interpretation of this. And then if there's perennials, is there a fall? So we have just a little bit of window, all the underwriters are familiar with this. We have internal tracking for substantial completeness. And it's a pretty simple procedure where the computer is just calculating, whether or not those key dates of, required documentation within 25 or 60 days have been received. The underwriter is keeping track of when the last thing they asked for was received in terms of that table at the top of the checklist. And this information is then transmitted to accounting. So it's very important this information is accurate because we do use it for commission purposes. All right, there's a picture of a bucolic farm. This is, I'm not going to go through this entirely, but we do have a microfarm and whole farm basic summary sheet on our agent portal that goes through, it's kind of a cheat sheet for if you've never written a lot of whole farm or you're unfamiliar with it, but this is kind of the bones of it. Notice that we have since updated this, but the coverage level here says 50 to 85%. That should be 50 to 90%. This is the old cheat sheet. We do have the new one corrected on our agent portal. All right, so some important dates. Late fiscal year tax filers, and so that's a tax filer that begins September 1st or later. November, the sales closing date is November 20th. Early fiscal year and calendar year tax filers. So for whole farm, those are, depending where you are, it might be January 31st, February 28th, March 15th. Depends on the insurance county. Micro farms are always, the sales closing date is always 1 month after that. They give micro farms some extra time. Revised July 15th for all filers, and contract change date August 31st. So this is one of the things that you will note that also changed this year. You can see that the producer premium, the subsidy factor, regardless of commodity, is now the same across the board. And this is taken directly from the RMA page. And the coverage levels have increased to 90%. So you can see the subsidy level, subsidy factor drops off the higher the coverage level, but up until 75%, it's the same regardless of number of commodities. So the subsidy amount is based on the commodity count determined by the commodity count calculation and the table specified in the AD. If the farmer or rancher qualifies as a VFR, the subsidy amount will be an additional 10 percentage points with no administrative fee will be due. So just if you're not familiar with this, the numbers in each column are the portion of the total premium paid by the taxpayer government. Microfarm automatically qualifies for the whole farm subsidy for 2 or more qualifying commodities. Combined direct marketing commodity will count as 2 commodities regardless of the number of actual commodities reported as combined direct marketing. So this is the premium discount for commodity diversification based on commodity count. Commodity count is a measure of the diversification of a farming operation. Feature of whole farm is that premium is discounted as the commodity count increases. The maximum diversification discount is realized at a commodity count of 7 commodities. The commodity count is also used in determining eligibility in some instances. Commodity count of 1 may restrict eligibility for whole farm. So in this example, below we have the farm with apples, grapes, pears, and cherries. But because of the mix of commodities and the revenue associated with each commodity, it actually only counts as 3. We'll get into the math behind that in a second, but that can be confusing for people sometimes. I won't, work this out, but this is an example of how the diversification factors work for different commodities. How to calculate commodity count? I will preface this by saying, if you, and this dovetails also with what I said at the beginning about eligibility, especially for those circumstances where you're dealing with a operation that is kind of hovering on the margin between maybe say 1 or 2 commodities, and there's a potential chance of eligibility. You can work these out by hand, and we will show you how to do that math. But we always recommend you run a policy through the quoter. And if you're keying, you will have flags that will come up that will tell you, Easy Rate Pro will tell you exactly how many commodities you're qualifying for. And so in an instance where there might be an eligibility question related to potatoes because it's only the single commodity, or single commodity with plan 2 or 3 available, you hate to get that letter like, sorry, you're not eligible. So each separate commodity code on the farm operation report is counted once, except for the combined direct marketing commodity code, to determine the number of commodities regardless of the number of times the commodity code is used. A commodity must be large enough in terms of the overall operation to account for purposes of the subsidy and diversification factors. RMA developed the following calculation, which is done in the system to count qualifying commodities. Remember, though, total revenue from all commodities on the farm is what insurance is based on. The following is only to determine if the commodity's expected revenue is large enough to count for commodity count purposes. So this is the math. You number of commodities times 0.33 times the total expected allowable income, and then in the example, there's 1.2 million and change expected income, and so the qualifying revenue threshold for any commodity is 133,207. So if you have multiple commodities and one of them doesn't meet that threshold, it's not going to count as an individual commodity. So there's an example of the math. We do get that question a lot, saying how much does my commodity, how much of a commodity does my client need to plan in order to count to qualify for higher diversity? This is the math, but again, Easy Rater Pro, Quoter, they're your friends. They'll just do that math for you. There are situations where individual commodity code expected revenue does not meet the minimums, but you can group commodities to count for higher coverage. So in this case, we have a whole bunch of commodities that are the expected revenue of 15,000, commodity is 170,000. So they have 4 total commodities that are actually growing, but these 3 that are 15,000 don't meet the qualifying revenue threshold, but you combine them and they can count through the combined direct marketing commodity count. So again, remember that all commodities are insured just to calculate expected revenue if the expected revenue for commodities is large enough to be considered for the diversification discount. All right, so this is a little bit of what happened, well, last year that's going to apply to this year. But the beginning farmer rancher benefit, the definition was changed to allow qualifying insureds up to 10 crop years from 5 crop years previously. Additional 5% premium subsidy for the first 2 crop years, additional 3% for the 3rd year, and additional 1% for the 4th year. This is in addition to the 10% premium subsidies that beginning farmer ranchers already receive. If a BFR's eligibility status changed due to this legislation, it must submit a new or amended BFR application on or before November 30th, 2025 for a 2026 policy with sales closing date on or after July 1st, and then before November 30th. For those policies with sales closing date after November 30th, the BFR application is due by the applicable sales closing date. So, and again, whole farm increased the maximum insurable coverage level from 85 to 90%. So in addition to the diversification and subsidy of premium discounts apply. So purchasing underlying NPCI buy-up coverage levels when purchased in conjunction with whole farm, the total liability from those policies covering whole farm covered commodities up to 50% of the whole farm policy liability will be used to adjust the whole farm liability amount for premium calculation purposes. The liability adjustment will be used only for premium calculation will result in a reduced amount of whole farm premium. Beginning in 2024, producers were allowed to opt out of this. All right, so what does that mean? Insureds can choose to exclude their underlying buy-up NPCI from becoming primary insurance. If chosen, the insured will not receive an adjustment to the insured revenue for premium calculation adjustment purposes. The indemnity will only be counted as revenue to count if it and the other crop, hail, NAP, or private sector policy losses exceed the whole farm deductible. More on this a little later in the presentation. And it's one question we get a lot about that is, can you do an a la carte opt out? Keep this NPCI policy, but exclude this other one. No, it's an all or none. You either opt out or you opt in. And you can see on the application, the little highlight section, check yes if you want to exclude, opt out, or FCIC's reinsurance policies from becoming primary insurance. So make sure your insured understands the impact of this decision if they elect to exclude their FCIC policies from becoming primary insurance. Again, that reiterating that change produced with underlying CAT policy has since 2024 has been eligible for whole farm or micro farms. However, CAT does not count for premium calculation purposes, and any CAT indemnity will be included as revenue to count on whole farm, micro farm if it neither crop, hail, and NAP private sector policy losses exceed the whole farm, micro farm deductible. This is again separate from the opt out discussion for FCIC reinsurance policies. Quick note, nothing prevents an insured from obtaining other insurance not authorized under the Act. The insured may receive benefits from NAP and receive an indemnity under whole farm for the same policy year. Any NAP payment excess will be counted. Private policies, hail, any indemnities received from these policies will not be considered revenue to count unless the total exceeds the insurance deductible under the policy. In both cases, the total amount of such indemnities that exceeds the deductible included as revenue to count. More on this in the claim section. So this is an example of how you do that. Basically, if the entities received from those were 35,000, insurance deductible 32,500. No expense reduction factor is applicable in that example because that's 2,500 revenue to count on the claim. This is something that's been in place for a while, but I always like to mention it. As of 2020, state and federal disaster program payments will be excluded from revenue account and all revenue determinations. These payments do not affect whole farm payments. Okay, and then so how does coverage work? Whole farm insurance product provides producers risk management protection for all commodities on the farm. So if the insurer produces the commodity, earns income on it, and reports that income to the IRS, it's going to be covered under the whole farm policy. This is part of the question about entity verification and capturing the whole farm operation. That definition with produces commodity, it's also inclusive of purchase for retail commodities. Commodity lists for each county in the actuarial documents. If a commodity is not specifically listed in the actuarial documents, use one of the other categories. So like other aquaculture, other commodity marketing. We get some of these niche crops that fall into the others, but it's not as common. Provides protection against loss of revenue due to unavoidable natural disasters during the insurance period that a producer expects to earn or will obtain from commodities produced or purchased for resale during the insurance period. So the approved revenue is lower than the total expected revenue from the farm operation report or the allowable whole farm historic average. Coverage levels range from 50, and this has changed this year, no longer 85, but up to 90%. Policy year, calendar year, 12 months between January 1st through December 31st. Early fiscal year, ensure the fiscal year begins prior to September 1st of the insurance year. So in that example, producer's tax year is August 1st to July 31st. That's an early fiscal year filer. The same sales closing date as the regular calendar year filer. Late fiscal year filer is the insurer for the fiscal year begins September 1st or later. And in this example, with a late fiscal filer, the sales closing date is November 20th. The lag year is the tax year immediately preceding the insurance period. What is the insurance period? Insurance period is the 12-month period corresponding to the producer's tax year, beginning of the calendar year in which the sales closing date occurs. Tax year is the annual accounting period for the farm operation, defined by the period used for tax purposes. Again, calendar year, fiscal year, and it could be a early fiscal year or a late fiscal year. And the fiscal year period of 12 consecutive months used for accounting tax purposes, and the last day of the 12th month, as long as the 12th month is not December. As an example of how calendar year filer works with January 1st to December 31st, the insurance period, the commodities covered, produced, and that's an important definition because we run into a lot of this with, let's say perennials that are hanging onto the tree where it might carry over from one insurance period to the next. We get a lot of this with citrus, where maybe, calendar year filer of citrus, maybe they're harvesting it in mid-December, maybe they're harvesting it in early January, but depending upon when that commodity is produced is in the different insurance period. There can be special circumstances in terms of doing yield history for that, which is a little bit beyond what I'm getting into. But in terms of produced, it's when the commodity is considered produced when it's mature to the extent that is generally saleable at established markets, regardless of whether or not it's actually harvested by the end of the insurance period. Citrus and a few other commodities generally fall into that special circumstance. So early fiscal year filer, this is an example. Their fiscal year is May 1st through April 30th, so that's early fiscal year. Same sales closing date as calendar year filer. The late fiscal year begins November 1st. That's after September 1st, so it has the sales closing date of November 20th. And again, this is just further reiterating those same examples. Calendar year or early, sales closing date, that's normal sales closing date. Late fiscal filer is going to have that November 20th sales closing date. And the tax years that you need for all those, so we're in the 2026 tax period, or excuse me, 2026 insurance period. So the tax years used for the whole farm history are 2020 to 2024. 2025 is considered the lag year. The late fiscal we're in the 2026 policy year, but the tax years for the late fiscal are 2019 through 2023. 2024 is considered the lag year and not included in the 2026 whole farm history period. The whole farm history period for a calendar year or early fiscal year filer under microfarm. So microfarm is a bit different because we use the lag year as part of the whole farm history period. So for 2026 policy year for microfarm, again, is one of the circumstances where you can have minimum of 3 tax years as opposed to the 5. We'd have 2023 to 2025, 4-year 2022 to 2025, and 5 would be 2021 to 2025. So when does insurance attach? For a new insured, coverage will begin the later of the beginning of the insurance tax year, or 10 days after the acceptance of the application. For carryovers, coverage begins the beginning of the insured's tax year. There's no lapse in whole farm coverage for natural causes between the previous policy year and the current policy year, provided all requirements are met. When insurance attached for carryover insured, loss of revenue in the current insurance period resulting from damage to insured commodities or from unavoidable natural causes that occurred in the previous insurance period are covered if all other whole farm requirements are met, including good farming practices. And there's the exceptions there. Insurance will not be provided for declining prices that continue into the current insurance period or for changes due to a reduction of irrigation water supply that are known or should be known at the time the I-4 is submitted. For example, a farm experiencing reduction of lack of irrigation water that's known or apparent prior to when the I-4 is submitted, you must reduce the amount of acreage to be planted under irrigated practice. Or if you lose your water right or irrigation water is for some reason no longer available, you record the commodities as non-irrigated practice with appropriately reduced yields on the I-4. Follow the expected value guidelines for determining expected values at the time the I-4 is completed when declining prices from the previous insurance period continue into the current insurance period. However, any revenue lost because of damage will only be covered the year immediately following the insurance period when the loss occurred and will not be covered for subsequent years. All right, so this is the last section I'm going to do before Clacey jumps on. Qualifying person criteria and insurance eligibility. So as I've noted, there are circumstances where not every operation is eligible for whole farm. So how do you know whether an operation is eligible or not? All right, what is a qualifying person? The entity must be eligible to receive federal benefits, be a U.S. citizen or resident, file a Schedule F tax form or other farm tax forms that can be converted to a substitute Schedule F. Remember to check that the entity and tax forms match. The Schedule F or substitute Schedule F must cover 100% of the farm operation. This is one of those ones where, especially when we're getting substitute Schedule Fs, if you have an entity that you have pass-through income for, you have the farmer and his wife that are filing taxes as individuals. They have a LLC for the farmer Schedule F, and he submits the application just based on that LLC for his wheat crop. But it turns out that the taxes flow through to him as an individual. And they also have a farm stand that is a separate pass-through entity. And his wife also has her own Schedule F for her little strawberry patch. All that income, whether it's on that one farmer Schedule F, because it's flowing into that one tax entity that the whole farm policy is written under, that's all revenue to count. That's considered part of the farming operation. So it's something to bear in mind. Be engaged in the business of farming and derive revenue from the production of commodities and derive not more than 50% of expected revenue from commodities purchased for resale. So in that example with the farmer and his wife and their farm stand, if their farm stand, if the income that's flowing into their tax return is derived more than 50% of purchase for resale from their farm stand, that becomes an eligibility issue. One thing to keep in mind with purchase for resale is that expected revenue is not, the gross revenue they're receiving from the purchase for resale, but it's the net revenue. So we subtract the cost basis of the purchase for resale commodities. A company must verify that the applicant is qualified to be insured in the whole farm before accepting the application. Substitute Schedule F, again, we see a lot of these persons who do not file a persons who do not file a Schedule F farm tax form must report and certify allowable revenue and expenses in the same manner as provided on a Schedule F tax form using a substitute Schedule F. Must be signed. We always encourage the producer's tax accountant to complete the substitute Schedule F because this can be complicated, and we sometimes see problems when people fill them out on their own. But again, we have a online substitute Schedule F, and it does have to be signed by the insured because that's them certifying this is an actual representation of their taxes. In addition to the substitute Schedule F, such persons must provide the farm tax forms filed with the IRS and supporting records for each year. No Schedule F tax form was filed, including statements reflecting other income and other expenses. So again, it's that entity question. The entity must have tax returns, including farm taxes for each of the 5 years of the history period for the same tax entity and farm operation as the insured person for the policy year, unless, and there's some exceptions to this. So changing tax ID or entity without altering the farm operation, spouses filing taxes as a partnership instead of as an individual, forming a corporation, successor entity, etc. Purchasing, leasing, or inheriting a farm operation, 90% threshold there, and the tax records of that operation are available. Other special situations that allow some differences in the 5 historic years. Late fiscal year tax filer, we talked about that. Entities that do not file taxes with the IRS but are still eligible for federal benefits, tribal entities specifically. Producers who are physically unable to farm for 1 year, and USDA qualified veteran and beginning farmers and ranchers with as few as 3 tax year records. I will also note there's another special circumstance for microfarm, which we'll get into later, that changed as of last year, using a different person's taxes. All right, but in this case, to further that point, how do you, if you have less than 5 years of taxes, how do you calculate that? Because whole farm is still going to need to make that historical revenue calculation based on 5 total years. So in this example, you've got an operation where they only have 4 years of tax history, including the lag year, and they're eligible to use. They're still eligible even with less than 5 years of tax history. So 2022 is the lowest amount of revenue. That amount of revenue gets doubled, right? And so then that 112,000 is counts towards 2021, and it's used to calculate the 5-year average. Similar example, the operation has less than 5 years of tax history, but we can count the lag year because they are eligible to do that. The lag year has $160,360. We use that as part of the 5-year calculation. When insured doesn't have 5 years of historic allowable revenue for microfarms, microfarms again is one of those circumstances where we'll often see less than 5 years. So again, that lowest amount is just used to populate the missing years to get to that 5-year tax history. Here in microfarm, they have 4 years, 11,000. We're going to use that to get to 5. If the insured purchases, inherits, or leases another person's farm operation, they may use the other person's tax returns, including adding the amounts to their allowable income and expenses for the particular year. If the entity obtains control of at least 90% of the other person's farm operation, including the land and facilities, irrigation equipment systems, greenhouses, and other facilities, for each year, the other person's tax returns that the current insured intends to use, the other person had an insurable interest in all commodities produced in the farm operation of the current insured. For the operation the current insured obtained, filed federal income taxes for the revenue received from those commodities, and is willing to provide all records necessary under this policy, including the income taxes necessary. So if you want to do that, there's a couple specific things you have to do. We need a written request to use the other person's tax returns for the specific years, copy the other person's tax return for each year the applicant or insured uses, Completed and signed whole farm history report that represents the combination of the applicant's insured allowable revenue and the allowable revenue of the other person for the applicable tax years, and that verifiable documentation we met that 90% threshold. That's in general when we run into things where people want to do this, but they're not able to. It's because that 90% threshold is not met. The other person whose tax returns the applicant wishes to use had an insurable interest in all the commodities produced in the farm operation. Yeah. Again, this kind of stuff, we got to have all this documentation in order to do it. Other eligibility questions, the liability limit is 17 million for any specific policy. That's an eligibility question. Farm operation will be ineligible if insured revenue is greater than 17 million on the sales closing date. If the revised farm operation report shows insured revenue exceeds 17 million, then it gets capped at 17 million, and all revenue earned considered revenue to count. You can see this chart over here for, depending on the coverage level used, what the maximum farm approved revenue can be. So if you have a 50% coverage level, for that 17 million, it's 34,000. 90% coverage level for that 17 million, it's 18,000. So 18,888,888. Again, that same question about commodity counts and eligibility. I've kind of beaten this one to death, so I won't really go into detail, but definitely make sure with potatoes or anything that also has revenue protection available for their commodity, that they have more than one commodity count where it's ineligible. And the farm operation includes any revenue from controlled substances. The plant cannabis sativa is not considered a controlled substance when it qualifies as industrial hemp. A lot of states have legal marijuana, so if a farm operation has a marijuana business as part of their operation, and then that's going to run into eligibility issues. All right, that's it for me. Thank you very much, and I will let Clacey take over the presentation.
Good morning, everyone. Can you see my screen okay?
Yes, we can see it. Thank you.
Perfect. Thanks. All right. So we're going to bop around a little bit, and we're going to start with livestock and nursery limits. And so for both livestock and nursery, we have an eligibility limit of $2 million with a soft cap. Soft here meaning that whole farm will provide up to $2 million in coverage for any size operation. It's not going to make them ineligible, but they're only going to cover $2 million. However, all of the revenue earned from those livestock, nursery, greenhouse commodities will be counted as revenue to count. So I know we've gotten some questions in the past about, a ton, very large livestock or nursery operations, and they've got $10 million worth of livestock. Is this a good policy for them? Probably not, because they're only going to get $2 million worth of coverage. So just keep that in mind. And so this slide shows an example of the capping procedures. So this example here, it's a total expected revenue of $3 million, and then it just shows how everything is kind of prorated down. And I won't read these figures out loud, but this is a good slide to reference if you do run into that. It works the same for nursery limits as well. When we talk about organic certifications, we've got the definition here of certified organic acreage. Acreage and certified organic farm operation that has been certified by a certifying agency is conforming to organic standards in accordance with this language here. So the main thing here is that organic prices can be used for the expected value, like that's what we want to do for that certified organic acreage, unless it's not actually certified. So we do have to prove the certification in order to use that organic price. We cannot use organic prices for commodities that are not certified organic. Even if they're going to be, at sales closing, we will plug in a conventional price at that point. If they do get that organic certification, After that point, before harvest time, contact your underwriter and we can make that adjustment. So the handbook gives some requirements to allow producers to report acreage as certified organic when the producers have requested an organic certification by the date the R4 is due. Organic prices can be used for expected values for animals, animal products, and acreage only. Organic prices do not apply to transitional or buffer zone acreage. Insureds that have an organic certificate or documentation they have requested in writing a written certificate or other written documentation from a certifying agency by the R4 deadline are eligible to receive an organic price for their commodities grown on certified organic acreage. So we can use those organic prices if they have requested in writing a certificate from a certifying agency and they have received a valid certificate dated prior to harvest and provide a copy to the AIP, or the operator tenant has an organic certificate. We will be checking for this. We will be asking for this. The Integrity website, it gives the link here, is a really great tool to be able to go and kind of check on that and see if it's still in date. And that's probably, excuse me, the biggest obstacle that we run into is, it's an old certificate that's provided. So we want to make sure that it's valid for the commodities that are being produced on that farm operation. The insured is required to provide the AIP with a copy of that organic certificate or documentation that they have requested in writing by the R4 deadline. If those expected values are going to be based on organic prices, if the AIP has reason to request the organic plan, the insured must provide a copy of the plan. So not just the certificate, but a step further in the plan. Plan might be a large document, and so copies should not be requested unless there's specific concerns. So I want to say it's pretty rare that we do ask for that, but if we do ask for that, they will need to provide that. Copies of the written organic certificate must be valid at the time a loss claim is submitted and organic prices are used. If they do not have a valid certificate at claim time, the insured revenue will be recalculated without the organic expected values, and any expanded operation factor attributed to having a valid certification will be revised accordingly. If the insured is a newly certified organic grower and is using the process of documenting their request for certification in writing from a certifying agency for acreage that will have an effective date after the R4 date, but prior to harvest, the insured must have an effective certification date prior to harvest of that crop. If the insured certification does not have an effective date prior to harvest, the expected revenue will be recalculated using the non-organic expected values. And so this is just the copy. Obviously, this is an older copy because you can tell by the certification dates, but this is an example of what one of those might look like. They're all going to look a little different depending on the organic certifying agency. So switching gears here to talk about the WFRP application, some of the most important things that we're looking at the beginning is the type of filer. This is going to depend on when your sales closing date is. So whether they're calendar, early or late fiscal years. If they have other insurance, so do they have other MPCI insurance? Do they have crop hail insurance, other private products? Do they have NAP coverage? And then entity structure, and this is a biggie. Do they have related entities either owned or having an interest in, and are they vertically integrated? And if you have any questions at all about entity structure, please don't hesitate to reach out to your underwriter and we can talk through, any of those scenarios just to make sure that we get the right applicant name and tax ID on the application. We also need to know the county where the majority of the total expected revenue will be produced. And in the example case that we've got throughout the presentation, it just happens to be Yakima County. But we do get that question quite a bit. We have a farmer over multiple counties. What county do we put down? And the counties could differ with their ratings because each county can be rated differently. We're looking at where that total expected revenue, where the majority of it is going to be produced. Not necessarily acreage, but the dollar amount. and that's what county you'll be putting down. We do have a agent and underwriter checklist that'll be pushed out to, all of the places where we have things. It'll be on the website for sure. And if you need a copy and you can't find it, reach out to your underwriter. We'll be glad to zip it over to you. It is fillable. And it just kind of walks you through the things that we're looking for. This top section here, and I think Kyle already alluded to it, this is what we're looking at in what we call our 10-day review. So our initial review, when we first open up that packet and we say, okay, do we have all of the forms? We're not necessarily verifying everything on every single form, but just getting them booked into the system so that we can get them transmitted through pass timely. And so our number one job, the very first thing that we do is determining if we have all of the forms that we need to start underwriting. And so, there is the note here, all items on the left-hand side, top of our checklist could be needed for new or renewal sales closing packet. And it says could be because, the pre-acceptance worksheet, that's only going to be required for perennials. Market animal and nursery inventory report, that's only needed if there's market animals or nursery on there. And then, the APH, ARH for crops with underlying MPCI, that's required if you have the MPCI. But if you have crops that don't have that underlying MPCI, you're not going to need, that number 3 there. But all of the rest of these forms are going to be required. And if not, the underwriter, if they're not received, the underwriter will be contacting you and we want to get that in. But there is some language in the commission schedules that do say, commission will be reduced by so much if it's not within so many days. And this is what we use as our guide for that. Before accepting the application, the companies must ensure the application is accurate and complete, plus ensure it is for a qualifying person with an interest in revenue derived from the commodities to be insured, contains all the required information according to the WFRP policy, and is for the same person as the person that filed the federal income taxes with the IRS for the tax year. And again, it's going to sound like we're beating a dead horse, but that's because we are, because we keep running into issues with this. We're looking at the main tax form, so the 1040, the 1065, or the 1120, or a version of those, not necessarily just the Schedule F, because you can have a name and a tax ID on the Schedule F that doesn't match that main tax form. So we are looking at that main tax form. We want to know that it's signed by the person to be insured or by the authorized representative of the person, and the application will be rejected if all requirements for acceptance are not met. The original application and a letter explaining why the application was rejected will be sent to the applicant if that is the case. Our goal is not to reject that, so we're going to do everything we can to work with the agent to try to make sure, if there's something missing, we get that accounted for, which is also a great idea to get things in early prior to sales closing. But that's my soapbox and I'll get off of it now. And so this example here shows, and of course it's blocked out on this tax snippet for privacy purposes. We didn't want to, show anybody's actual social security number and EIN, but we do not want these redacted when they come in. We need to be able to see the full tax ID number there, and on the application we want to be able to see the full tax ID. And so make sure that we can see those and verify that those are the same name and tax ID. When we're looking at SBIs, I'm not going to read through all this because it's the exact same as multi-peril SBI lingo, but just make sure that if they have the 10% or more interest in there, that they are listed on the application. And again, if you come into a unique entity situation and you're not sure like who needs to be included as an SBI, reach out to your underwriter and they'll be able to help walk you through that. When we're looking at tax forms and allowable revenue forms, they go hand in hand. So allowable revenue is defined as farm revenue specified by this policy and including applicable adjustments from the production of commodities produced by your farm operation, purchased for resale, or purchased for further growth and development by your farm operation that the IRS requires you to report on farm tax records. So, a couple years ago, RMA completely removed the existing allowable expense reporting procedure. So that was a few years ago, but to compensate for that expense adjustment at claim times, RMA did add at that point a 40% reduction in expected revenue if the insured is unable to establish an intended commodity for which they reported expected revenue, or an intended commodity was destroyed prior to reaching maturity and not replanted. And so it's critical that insureds and agents provide all applicable tax forms with the statements for other income and other expenses, if applicable, with the application packet, even though there is no need to complete an allowable expense worksheet. So this next slide will show kind of an example here of why we need to see this. Line 27 is storage and warehousing. And there's another example, I believe, in the presentation that shows a number in there. But we are looking there to see, okay, that's going to be post-production expenses. And so if there's a number in that line 27, we're going to be taking that amount and subtracting that from the allowable revenue from line 2 on the Schedule F above, because we can't insure the post-production. And so storage and warehousing falls into that post-production. We're going to be subtracting it from the allowable revenue. A lot of times in line 32, there are other expenses, and it'll say see statement 1 or statement 13 or whatever it is. And if it does, allude to another form in the tax packet, we need to see that as well, just to make sure that there's no post-production or purchase for resale stuff that's hidden in there, because sometimes we've saw that before too, listed in the other expenses. It'll say, peppers purchased, and it's like, well, what is that? And it's peppers purchased for resale. So accountants will sometimes put different things in different places. So it's always kind of surprising for us to figure out where stuff is. So even though they all kind of have the same rules, they all seem to do it a little bit differently. So, our job is to kind of, follow the money and figure out where that information is and what the information is telling us. The approved revenue is used to calculate the whole farm coverage amount and the premium. It's going to be the lesser of the historic average or the total expected revenue. The total expected revenue will be covered later on, but it is the expected revenue based on the current year's commodities intended to be produced on the farm operation. So when we look at the forms, you have your allowable revenue worksheets, which are worksheets that identify the allowable revenue, right, based on those tax returns. And so those funnel into a whole farm history report, which we'll get to. But the whole farm history report gets us to our historic average, and then we compare that to our total expected revenue from the farm operation report. So we're comparing those two, and then we'll get the lower number to be our approved revenue for the year. The tax forms required for calendar and early fiscal year filers for a 26 policy year, it's going to be 2020 through 24. You'll notice 25 is not on there, and 25 is what's known as the lag year. And RMA gives us that for whole farm so that it gives folks times to file their taxes, because a lot of folks don't have their 25 taxes filed at this point, even though they could be signing a whole farm application now for the spring. Allowable revenue worksheets must be completed for each tax year. And for late fiscal filers, the reporting is a little bit different. You're going to be looking at 19 through 23, with 24 as the lag year there. And again, if you have any questions on this, contact your underwriter and they'll be able to look at the specific example that you're looking at. But allowable revenue specifically includes the sales of animals and other commodities purchased for resale, less the cost or other basis of animals for those commodities, which gets us to line 1C of the Schedule F. We are going to include revenue from CCC loans forfeited. We'll talk about that a little bit more on the next slide. We're going to include the sale of animals, produce, grains, and other commodities raised, which is line 2 of the Schedule F. And then the taxable amount of total cooperative distributions, line 3 of the Schedule F, only include those directly related to the sale of the commodities. So we're looking at distributions for corn, not fertilizer. And so we need documentation. If you're trying to include line 3B as allowable revenue on the allowable revenue worksheet, we do need to know what is this for, and we want to make sure that it's for corn, not fertilizer. For claim purposes, only include cooperative distributions related to the sales of the commodities produced in the insurance period. And then we get down here to line 8, which is of the Schedule F, which is other revenue. Sometimes that can be included, but it depends on what it's for. If, again, we're looking at commodity sales, animal sales, that kind of stuff. If it's, something outside of that, that's not a commodity, it's not going to be included. So we include all revenue directly related to the production of the commodities that the IRS requires to be reported, included but not limited to revenue from bartering and payments from buyers for commodities for bypassed acreage. And then we do want to see the other tax statements associated with the other revenue. So usually there's another spot in the main tax packet where it'll kind of outline what that other revenue is. What we don't want to include is if you have sold a piece of equipment and the accountant put the sale of a tractor there in line 8. So, tractors aren't insurable under the whole farm policy, so that wouldn't be included as allowable revenue. Now, as promised, CCC loans in more detail with regards to sales of animals and other commodities purchased for resale, less the costs or other bases of such animals or other commodities, line 1C of Schedule F, include revenue from CCC loans forfeited. So for some commodities, such as peanuts and sometimes cotton, when you sell them to a private buyer, the buyer pays back the CCC instead of you, the farmer. In this case, you keep the CCC loan money and don't pay it directly back to the CCC. Instead, the buyer pays the loan back and pays you only the difference. So in these cases, the result is that you are actually receiving the amount of the CCC loan plus the difference, so the total amount will be included in your revenue. So again, this is why we kind of say follow the money. And people get hung up on the word forfeited and is it included or is it not? We're looking at where was the money paid for the commodity? Was it split up? Was it paid back? 2 examples here. The first one receives 50 cents as a CCC loan. Cotton sold to a giner at a price of 62 cents in the form of 12 cents paid to the producer and 50 cents paid directly to the CCC loan to repay the loan for the producer. So the producer keeps the 50 cents originally obtained from the CCC loan, and then they also get the 12 cents from the giner. So that 50 cents that was originally paid to them plus the 12 cents makes them whole at the 62 cents. The revenue result is the same for a producer who pays back a CCC loan to the CCC, receives the full payment from the buyer for the commodity. So if they were to pay back that 50 cents and then get the full 62 cents from the gen, it would be the same net difference. A second example here, the CCC loan was $3.53, was provided to the producer. The producer sells to the local elevator for $367. The elevator pays the producer the $367, and then the producer pays back the CCC at the $353. So 2 different ways, same outcome. When we're looking at specifically excluded from allowable revenue, that's going to be revenue from any post-production operations, any net gain from commodity hedging or speculation, revenue from commodities in which the insured does not have an insurable interest, revenue earned from custom hire or rental activities, or cooperative distributions that are not directly related to the sale of an insured commodity. Continuing through, if you earn revenue as an animal contract grower, if there's revenue from wages, salaries, tips, cash rent, revenue from government agriculture programs, disaster payments, replant payments, revenue from uninsurable commodities such as animals for show, sport, timber, forest, and forest products and controlled substances, CCC loans repaid, except those repaid by the third-party buyer, crop insurance indemnities, prevented planting payments from other FCIC policies, the value assigned for uninsured cause of loss or abandoned acreage, and accrual adjustments for the beginning and ending accounts receivable and inventories. Different impacts on claims, so we'll look at the next slide. All of these are included in revenue to count for claims, so counted against the producer as revenue to count is going to be the value assigned for uninsured causes of loss or abandoned acreage, accrual adjustments for beginning and ending accounts receivable and inventories, crop insurance indemnities authorized under the Act and prevented planting payments from other FCIC policies, not including replant payments, any expenses which reduce the price received for a commodity that were not considered when determining the expected value of that commodity, unless we determine that the reduction was due to an insurable cause of loss occurring prior to the harvest or the end of the insurance on the commodity. So, for example, if the price you receive for a commodity is reduced due to expenses such as seed costs or drying expenses, but the expected value established for the commodity was not reduced by such expenses, then those expenses are going to be added as revenue to count. Net gain from commodity hedging and speculation, any payments for damage to insured commodities from NAP payments or indemnities from insurance policies not authorized under the Act that exceed the insured's deductible. We hit on post-production a little bit earlier, but let's dive into that a little bit more. It's defined as any operations not included in the definition of market readiness operations. They're performed after producing and harvesting the insured commodity and preparing it for sale. So post-production operations must be removed from the allowable revenue. These consist of costs from activities that occur after harvest of the crop to get the crop ready for the targeted market. These activities either have expenses associated with them, such as sorting, grading, waxing, washing, labeling, trimming, packing materials such as boxes, cartons, bags, packing of commodities after they are harvested, including in-field operations, cold and controlled atmospheric storage, or they add value to the crop due to the activities performed, such as the value of wine compared to grapes, the value of gift baskets of commodities compared to the individual raw commodity prices, the value of juicing or processing into jams or relish compared to the harvested fruit, or the value of bonsai or braided ornamental trees compared to the containerized tree with no added value. Post-production operations that meet the following requirements as market readiness costs do not have to be deducted from the allowable or expected revenue. So these are two different things. You have the post-production that has to be taken out, or you have market readiness that can be left in. Costs that be considered market readiness must be the minimum amount required to remove the commodity from the field and make it market ready, and it must be performed in the field or on land within a close proximity to the field, and it must not add value to the commodity. The added value of products made from insurable commodities, such as wine made from grapes, is not insurable under whole farm and must be excluded from the expected or approved revenue. The value of insurable commodity prior to making it into other products may be insured and reported as expected revenue if adequate records are available to determine the production and value of the insurable commodity. So if you have any questions on whether it counts as market readiness versus post-production, again, reach out to your underwriter and we can talk through that specific scenario. Here is, a line 27, storage and warehousing. This shows an example where there's $95,000 that is storage and warehousing. So that's going to be removed from the allowable revenue in this example. So the allowable revenue worksheets, we'll see an example on the next slide, but they must have an allowable revenue worksheet for each year. So each year, the tax history period, we're going to have 5 of these total. If the insured is a carryover within AU country, then they only need to fill out the most recent year in the 5-year historic base period. If the insured is a carryover but transferred to NAU, make sure we have all the tax forms and the allowable revenue worksheets for all years in the historic base period. And so we can send a transfer request to the prior AIP, but it's kind of hit or miss what we get. And then sometimes they don't seem to have all the records either. So just making sure we have a cleaner, have all the forms is going to be a cleaner transition process, and it'll just kind of help everybody out to make sure that we have everything and all of our ducks in a row. We can start underwriting. Here's an example. The left-hand side shows the Schedule F. The right-hand side shows the allowable revenue worksheet, and it just shows how that line 2 on the Schedule F is carried over to the first line here on the allowable revenue worksheet. So it's carried over and then brought here to the bottom. I mentioned the whole farm history report earlier, but now that we have reviewed the taxes and the allowable revenue worksheets, the allowable revenue numbers will be reviewed on the whole farm history report. This report documents the farm operations allowable revenue for each tax year used to determine their whole farm historic average revenue. This is one of those required forms that has to be in on or before the sales closing for the policy year. And here at the bottom is kind of what the meat and potatoes of that form looks like. These are the main things that we're looking at on that form. And we're making sure that it's carried over from those each allowable revenue worksheet to this whole farm history report. So each one of these numbers should be supported there by an allowable revenue worksheet. And so we've touched on this again, but this kind of breaks down how we get to the historic average revenue. It's going to be equal here to the higher of the 5-year average allowable revenue. And then if there's any adjustments, we have the revenue cap, which is 90% of the insured's previous year's approved revenue. Of course, these are all if applicable, and you have to elect these. These are going to be elected on the very first page of the application packet, so make sure that those are elected there. We also have revenue exclusion and revenue substitution. The indexed average revenue, if applicable, the expanded operation adjusted revenue, if applicable and approved. This number is then transferred to the farm operation report to compare to the expected revenue for the policy year to determine the approved revenue. So if the operation is growing, there's two ways to impact the historical average revenue. Number one is the indexing. It's optional. It's a procedure that looks to see if the allowable income from either of the last 2 years is higher than the 5-year average of allowable income. And then if that condition is met, it increases the historic income based on how much the farm has grown over the 5 years. It's not to exceed the highest allowable revenue of any year in your history period. So we get this question a lot. It's like, why is my indexing just showing, XYZ number? And then when you look at the allowable revenue for each year, it's like, okay, it's getting capped by this highest year in here. It used to didn't do this, so this is still kind of an adjustment, I feel like, for a lot of folks, because used to it was just wide open and they could get, crazy high indexing numbers. So RMA did put a cap on that to kind of rein that back in a little. Expanded operation procedure. This one requires a lot of records, and that's fine. We'll be happy to sort through those with you, but it's a lot of work, and it's not going to, it goes based on the simple average, not necessarily the highest number that you can get to. So the expanded operation procedure, if the records are provided by the insured that show the physical expansion in the insurance period of the lag year has occurred on the farm that support an expanded operation increase up to 35% over the 5-year, again, simple average allowable income. And so those are only the operations that meet one or both of these conditions will be allowed to have adjustments in the guarantee of a growing operation. And then only the highest one of those two is going to be applied if applicable. And so in this example, it shows that their index revenue is going to be capped at the highest year in the history period. And to qualify for indexing, you must have 5 years of farm tax forms in your whole farm history period, and the allowable revenue for either of the 2 most recent tax years in the whole farm history period must be greater than the average allowable revenue calculated there. So your simple average here is the 828,000. And then they do have in year 23 here, they have 849,000, which is higher. So that does qualify them for indexing. In this box 17, you can see index average is highlighted here, and there's a check yes or no. I will say, even if you think that indexing is not going to apply, I would recommend that you quote it both ways, because we have saw that even though indexing didn't directly apply to the policy, it changed the premium amounts. And so the premium is based on kind of some what ifs, and the differences between how the options kicked in by themselves versus if it was going based off an indexed average. So please be mindful of that. We recommend checking yes for indexing, but of course, that's ultimately the insured's decision with help of their agent. But just be mindful that even if you think indexing is not going to apply, it still can affect their premium. So make sure you check into that. When we look at expanded operations, the insured has to prove to the AIP that their operation has physically expanded during the insurance period or the lag year by adding production capacity to the farm operation. So they added land or they added a greenhouse, increasing use of existing production capacity. Maybe they're doing double cropping now, or they're beginning production on high density blocks or orchards. Maybe they made physical alterations to existing production capacity, so they added irrigation or began production on certified organic acreage. And so the AIP, at their discretion, must approve the farm operation as expanding operation. We will not consider crop rotation, planting pattern changes, or planting a higher value commodity without changes to the farm's existing production capacity to be physical expansion. So example here, if the insured planted more of their existing land to a high value commodity during the insurance period than in previous years that did not otherwise have a change in production capacity of their farm operation, AIP will not approve the farm operation as an expanding operation. Just because you always had that ability to plant watermelons instead of corn and made a farm management decision not to. Is kind of the thought there. We will also not consider on perennial crops beginning production on an orchard or grafted acreage or other unit of land if any revenue from the production on that land was generated during the insured's whole farm history period. And so that can get a little bit wonky, but we are looking at, the 5 years in the history period, and we're looking at those very closely. For livestock, if you're increasing the number of livestock expected to produce revenue during the insurance period with no other changes in the facilities or production capacity, that's also not going to be qualify as expanded operation. And again, must provide verifiable records that we agree are sufficient to determine the amount of revenue and expansion can be expected to generate for a farm operation that is expanding during the current insurance period by the date on which they submit their R4, or if it happened during the lag year, it needs to be sales closing or the first day of their insurance period. So that's another biggie that folks kind of get hung up on. They're thinking, oh, I can send it in by R4, but if it was during the lag year, it does need to be at sales closing. And, on the flip side of that, if they are planning on expanding during the insurance period and they submit a expanded operation request on their I-4, we may start to verify that, but it can't be fully verified until we see what's actually planted. So that final expanded operation number won't be finalized until R4 time and we see what was actually planted. We're required to consider increases and reductions. And so we can only consider the net increase in production capacity from the highest amount of production capacity of the years in the insured's whole farm history period when determining their expanded operation factor. And so the example here is how many acres that they had during their history period and lag year. So for 26, they were requesting an expanded operation factor based on 200 added acres in their current year to their existing 350 acres, because last year they had 350 acres. They're adding 200 acres, so that gets them to 550 in 26. So their net increase is only 50 acres, because if you look back in their history period in year 2020, the oldest year, they had 500 acres. So even though that feels a little bit off, we are looking at revenue above and beyond what was in the history period. So because they had, that 500 acres in 2020, their net increase is only going to be the 50 acres. And then we'll make the calculations based on an additional 50 acres. So when we look at non-organic expansion, which is what we've been talking about, we're limited to 35%. If we have an expansion due solely to certified organic acreage, we're limited to the greater of 35% or 500,000. And so expanded operations specifically for organic type expansion, if the insured's farm operation is expanding due to adding organic practice production capacity or beginning production on existing production capacity converted to an organic practice, they may elect to submit only the organic practice expansion for consideration to be approved as an expanding operation. If they do, they only qualify for calculating their expanded operation factor using the organic expansion calculation in the next slides. We will only consider the net increase in organic practice capacity from the highest amount of organic practice production capacity of the years in the whole farm's history period when determining their expanded operation factor. So similar kind of thing. And then this shows the actual calculation. I won't read through this, but that's a good reference slide to have. This example shows more of the whole farm history report, and it shows in this example, that you can go above the 35%, but still be under the 500,000. So that shows their expansion there, and how that affects their average amount. In addition to the indexing and expanded operations, there's several smoothing measures, which, are available as options to prevent large drops in approved revenue from year to year and help smooth out the historical values. Additional premium will be billed for the option selected. So we get the question a lot, does it cost me so much to add the options? No, it's not a direct fee, but because you are going to get more approved revenue, you're going to have a higher premium amount naturally. So we have the RS, the RX, and the RC here. The RS is the substitution, the RX is the exclusion, and the RC is the cup. And again, the cup is 90% of your prior year's approved revenue, and that's only for carryover policies. If they're transferring between AIPs, that still counts as a carryover policy. It's just the brand new policies that won't be able to qualify for RC. If the insured elects more than one option, the option with the highest resulting revenue amount will be considered elected when the whole farm historic average is determined. And if you check all three of those in Easy Router Pro or the quote, it'll show you those highest amounts as well. So that's very helpful. The substitution, a 60% revenue plug based on the simple average or simple index average revenue. Years having revenue less than the average can be replaced by 60% of the average to calculate the approved revenue. It cannot be combined with the exclusion election. So again, whatever gets you the highest amount is going to be used if they're all three elected. This example shows that, this one doesn't qualify for substitution because there's nothing that drops down below that. So RX is the one that we see that's probably used the most in practice. And that's where producers can drop the lowest year of revenue from the history and calculate the average revenue based on the remaining years. It cannot be combined with a substitution election again. You can elect all three, but whatever's highest is going to be what's going to actually apply. So this example here shows how that works out. And then the revenue cup, in box 14, you're going to have last year's approved revenue times 90%. So that's going to show you how much that's going to be cupped at. But as you can see, the exclusion here in this example is going to be the highest of the simple average, the substitution, and the exclusion. And so again, to summarize, I know these are a lot of the same words and it all sounds kind of similar if you're new to this, but we're looking at the highest of box 11, box 12, box 13, box 14, box 15. It's going to get you to box 16, and it's going to have the highest amount of those options. So switching gear here, the next step in the process is to review what the insured records that he or she intends to produce during the policy year, the expected yields and values and quantities of each planted commodity. So this is going to get us more over to the farm operation report at this point. We look at the total expected revenue from the farm operation report, compare that to the historic average from the whole farm history report, which we just went through to determine what the approved revenue is for the policy year. The expected value and yield source document certification worksheet is the starting point in determining those expected revenues. And so your expected revenue is a calculation. It's the from the value, the yield, and the acreage. And so price times quantity times yield is going to get you to that expected revenue. The expected value is the price the insured expects to receive for a commodity, less the cost of all post-production added value expenses. The expected yield is the yield the insured can reasonably expect the commodity to produce under normal growing conditions in the insurance period. So note that doesn't say the highest amount that they've ever produced, ever. It just says under normal growing conditions in the insurance period. And so here's an example of the expected yield and value worksheet. And so what you'll see here, the main things, on your commodities, you're going to have column 12, expected yield, and then 13 is going to ask for the source of that yield. And then you're going to have column 14, expected value, and then 15 is the source of that value. This is what gives the underwriter the roadmap to verify your policy. And so if this is blank, that doesn't help us any, and we're going to send that back because this needs to be completed. This is going to help us figure out, why you think you're going to get the yield that you're going to get and why you think you're going to get the value that you're reporting that you're going to get. We always want to make sure that the source is something physical and that it's included as necessary or as requested within the whole farm packet. So if it's, we're using the MPCI price, obviously we can get that. But if it's, the grower's personal records, we don't have access to that. So that, could be requested. We want to be cautious to never allow farm records or things like producer average as a source for the expected values. This source should be something concrete, obtainable for verification, and in accordance with the policy language and Exhibit 18 in the handbook. And that's really why we want to see what those sources are, because we want to make sure that it is in line with what the allowable sources are and what's most appropriate for that commodity. When we're looking at expected yields, the yield that you can reasonably expect your insured commodity to produce under normal growing conditions in the insurance period determined in accordance with the expected yield guidelines in Section 18. And so we want to make sure that the unit of measure is consistent with how the commodity is marketed, such as bushels, tons, pounds, cartons, head, and include the unit of measure immediately after the yield amount. And it always surprises me every year how many times this is left blank, and then we're trying to figure out, is this pounds, is this bushels, is this carton, or how does that convert to, say, like a NAP price, because it might be in hundredweight, it could be, and if you don't tell us, there's really no way for us to know. So having that information included in the packet is going to eliminate a lot of the back and forth between the underwriter and agent. Some of that is unavoidable, but at the end of the day, the more complete that you can make the packet, the easier it's going to be for everybody. There is a source hierarchy for the yields. If there's existence of MPCI or NAP coverage, that's going to be what we're going to use. If you don't have that, a 4 build to 10-year database period and certification for commodities not insured under other MPCI coverage. And we'll talk about that some more in a minute. Consideration for perennial commodities with alternate bearing or downward trending tendencies. That's important. And then the source documentation may be required at the underwriting application time. Expected yields must be reasonable, realistic, and consistent with available local agronomic information and supported by verifiable records, which must be provided if requested. The same commodity by rate code may have different expected values or expected yields based on practices, types of varieties, markets, planting seasons, or other reasons. So even though you may have, it's apples, there may be different values for different varieties. If you have eggplants in multiple planting seasons, you may have different expected yields, whether those are spring, summer, or fall. So, help us help you and, break those out on a separate line and, have that documented so that we can follow along. For commodities that are insured by another MPCI policy that provides individual yield or ARH coverage in the county where the commodity is grown will be that policy's average simple or weighted approved yield for all units on the farm's policy offered under the act, whether planted or not, that provides individual yield coverage unless the insured provides detailed documentation based on their past production practices and any changes to the production practices during the insurance period the AIP agrees demonstrates a higher or lower expected yield. Actual yield data under this new practice must be provided and serve as the base for the expected yield. The expected yield may be based on the expected yield determined by the AIP to be appropriate based on the provided documentation and the average yields produced under the new production practice approved by the AIP. The insured has produced the commodity in years prior to the first year of your whole farm history period, and the AIP agrees the years prior to your whole farm history period do not reflect the yield the insured can expect to produce during the insurance period. And the expected yield may be an expected yield as determined by the AIP using all years within the whole farm history period, including the lag year if available when the intended farm operation report is submitted. If they are not insured under an individual yield coverage policy that has been produced on the farm operation during your whole farm history period, the insured must provide a completed yield and revenue report for each commodity on or before the sales closing date for the commodities reported on their I-4 or at the time they file their R-4, but that's only for commodities added to the operation after the sales closing date. So the yield and revenue report for each commodity must contain a continuous record, that's important, it's bolded, continuous record of production history of the commodity beginning with the most recent year the commodity was produced on the farm operation to a 4 bill to 10 year of continuous production history. If the insured has less than 4 continuous years of production history of the commodity on the farm operation, a replacement yield will be included for each missing year, determined in accordance with the handbook procedures. The expected yield will be the average yield produced on the farm operation based on the insured's production history and any replacement yields if applicable. The insured must maintain verifiable records of yield and acreage for all years used to determine the expected yield, and they must provide those records upon a request. If the insured is unable to provide the verifiable records after any year that they have certified that they have produced the commodity that would be used to establish your expected value, that commodity will be assigned a zero yield for that year on the yield and revenue report when calculating the average yield. So we don't want to end up in that position. Nobody wants to be there and have that conversation. So make sure that they are, certifying their most recent year's production. Expected yields must be reasonable, realistic, and consistent with available local agronomic information and supported by verifiable records. The insured is required to provide such records upon our request. Yes, I know I'm repeating myself. It's important. This shows us here, our rounding rules based on your unit of measure. If you have bushels, cartons, lugs, hundredweight, it's going to be to the whole. Tons are to the 10th, barrels are to the 10th, dollars and pounds are to the whole. Okay, Exhibit 18 is key for yields and values. The following provides the methods and sources for determining the expected yields for the commodities. Again, if the commodity is not insured under an individual or ARH coverage policy, the insured must complete that yield and revenue report for the commodity. The yield and revenue report must be submitted on or before sales closing for the commodities report on the I-4 at the time they submit, or at the time they submit their R-4 if they are adding those after sales closing. Contain a continuous record of production history with the most recent year for a maximum of 10 years preceding the insurance period, including lag year. The policy language did change in 24 from the 4-year average to the 4 bill to 10. So here's some examples of what those might look like. If they, in this case, if they did not plant in the year 22, there's 0 acres, so that's not going to count against them. But if they did have acres, but they didn't report their production, then, then that's going to get plugged in as 0. The carryover must provide the most recent year if the commodity is planted. Continuity is not interrupted for any calendar year if the crop was not planted, prevented from being planted by an insurable cause, or not produced for an insurable purpose. So again, we need a minimum of 4 years, up to a maximum of 10 years. We have had the question come in the past, I've got 6 years. Do I get to use 4 replacement yields? No, because you have more than 4. So as long as we get you to 4 actuals, then we don't have to worry about replacement yields to there. It's only when you have 3 years, 2 years, or 1 year, or no years that a replacement yield will come into play. And this is an example of what the actual fillable yield and revenue report looks like. Make sure you're including what that record type is, because we do have to enter that into our system. And if it's not checked, then we're going to have to bug you and say, hey, what kind of record was this? And then we'll be able to go in and finish keying that. So this can get keyed into Easy Writer Pro in the Edit Commodity History tab. And it'll calculate those expected yields for you. This form also will do that here as well. And again, in this instance, there's 9 years of history, so there's no reason to enter a replacement yield in there. If you're using the individual form, please sign that. The insured and agent will need to sign that. If it's part of the packet, the signature at the end will be just fine. And just like an APH hard copy, records must be available upon request. If they have the missing year or have no records to make up the 4 years, then this language here comes into place with the replacement yields. So considerations here: if the insured has a multi-peril policy with NAU that encompasses all commodities covered under the whole farm, we already have that ARH APH in hand. If the insured has an MPCI with us that only covers some of the commodities, we need to have the yield and revenue reports for all commodities not covered by the multi-peril. If the insured has multi-peril with a different AIP, we need the APH for that other AIP. And then anything that's not covered under multi-peril, then I need to have the yield and revenue report. So if, the multi-peril is split up, maybe it's with a different agent, or maybe you just have it at 2 different AIPs, we still need that APH to verify the yield amounts, and then whatever's not covered under MPCI at all, we need to have that yield and revenue report. And so the bottom line, we need to have one or the other for all the commodities on the farm operation report. So here's some scenarios for commodities without underlying MPCI. The insured, here's 5 different scenarios, and then the different scenarios are shown examples in the next slide. So again, this gets kind of wordy, but these are good reference slides to come back to, once you're kind of digging through with your producer and saying, okay, how do I fill out that yield and revenue report? And do I do a replacement yield, or is it a 0? Or, kind of how does all of that work? So the first scenario, it doesn't have an example because it's straightforward. They have 4 years or more of records without breaking continuity for a commodity, whether it's a new or carryover. That's an easy, simple average. The next scenario, they have less than 4 years of certified or provided records that has the most recent year. So the lag year, did they provide the records? Yes. So the yield that we're going to use is the yield from that records. The year before the lag year, it shows year 3 here. Did they provide the records? No. Then they get a replacement yield. Year 2, no replacement yield. Year 1, no replacement yield. Scenario 3, a little bit different here. At least 1 year of consecutive records certified or provided in prior year's database, but doesn't certify the most recent year's history carryover. Use what they provided on last year's policy plus replacement yields, and a 0 for the most recent year. So they refuse to provide the lag year, so they get a 0 yield for that year. They had records for year 2 and 3, so we used the yields from those records. They had certified those to us previously. And then the oldest year, they did not produce the commodity, or they had no records there, then they get a replacement yield. Scenario 4, they have no previous records, does not provide any additional records. They are a carryover. We're going to use a replacement yield for the years prior to the lag year plus a 0 for the lag year that the commodity was produced. So lag year, no records provided, assign a 0 yield. And then the other years 1 through 3, they either didn't provide the records or they did not produce the commodity. There's a replacement yield. And so RMA did this as to kind of have a penalty for folks not reporting their production. They kind of give you the first year, as you'll see here, not a carryover. So it's a brand new policy, has no available records. You're going to use a replacement year for all 4 years here. So, replacement yield plus replacement yield plus replacement yield plus replacement yield divided by 4, it's going to be the same. But they didn't produce the commodity, they didn't have records. They kind of give you that first year to get into the program and to kind of get used to keeping those records. But once you're in the program, you do have to keep those records and say, okay, this is what my production was. So replacement yield is defined as the yield we determine best reflects the amount the insured can expect to produce during the insurance period obtained from the following most applicable sources for the insured's farm operation. So first one is FCICT yields. Second one is NAP yields, or if neither one of those are applicable, then we're going to look to cooperative extension if they can provide something, but that cannot be based on university trial data or crop budget reports. And so hopefully, the commodity will fall into one of these to where we can get a replacement yield. Now, this replacement yield, it says we determine best reflects. This needs to be provided by the insured agent on that yield and revenue report. There is a space there for replacement yields. It needs to be filled in there. It doesn't need to be us plugging that in for you. But we are going to verify it. And so if we need to adjust that, we will adjust that, but we don't need to be the one that's plugging that in there to begin with. That needs to come from insured with help of their agent. And here in the gray box, if there's no underlying NPCI and the insured is missing years certified in the 4-year history, then the above procedure applies for the missing years. Once reported, though, they must certify and or provide records for the most recent year in the database. In the base period, records must be continuous. Additional notes, for commodities without underlying NPCI, official NAP approved yield forms will be considered supporting records. And we saw those before and they look kind of like an APH database, same kind of thing. So we can use those as a supporting record. The insureds must have records to substantiate the NAP approved yields. And if requested by the AIP, then they need to have those to back those up as well. If the price or yield cannot be determined for a commodity because no acceptable price source exists or an expected yield cannot be established, the expected value of the commodity will be 0 and all revenue from that commodity will be considered revenue to count. We don't want to get in that position. There's a few instances where we've ended up there, but we really hope that we can find some sort of yield and price source because we don't like doing zeros. But if there's, nothing to support that, to say what they can get, sometimes we're just, locked into that by policy language. So if we do have the commodities insured with the underlying NPCI, that expected yield will be that policy's average yield, simple or weighted, approved yield for all units, whether they are planted or not, that provides individual yield coverage. And again, if they're not insured under that individual yield coverage policy, and they have been produced on the insured's farm operation during their whole farm history period, the expected yield will be the average yield produced on the farm operation during the 4 billed 10 years during the insurance period. If the insured has less than 4 years of production history on the commodity on their farm operation, a replacement yield will be included for each missing year. And the insured must provide verifiable records of yield and acreage for all years used to determine the expected yield when requested by the AIP. And then note, official NAP approved yield forms will be considered supporting records, and insureds must have those records to substantiate the NAP approved yields, and if requested by AIP, must submit those. And then NAP is the Farm Service Agency, the FSA office's non-insured assistance program. So I know that was a mouthful, but these slides are available on the NAU website, as well as the recording will be posted there as well if you need to go back and reference these at any point. And of course, contacting your underwriter. And I believe Mark will be taking it over from here, starting with value. Whenever you're ready, Mark.
You hear me and can you see my screen?
I can hear you and I can see your screen.
All right. So I get
Good to go.
to talk about expected values. So we're on this section here where we're going through the values. This is probably the hardest and most important part of whole farm, but the source that we use to determine the expected value has to be that price that reflects the price that the commodity can expect to make during that insurance period. Um, So, for example, if the commodity is traded on the futures market, but at the time we're setting up the policy, those prices have gone down, we won't be able to use that FCIC price to determine that expected value. Also, for the source, we need to look at where the commodity is marketed. So if you have a commodity that has a cost basis that's or not a cost basis, but a basis to get that commodity to market. We'll have to put that basis into the pricing of the commodity. Most of the time, that basis is a negative, but there are situations, for example, like corn in Idaho, where there's actually a positive basis that can be added to that futures price. Um, we also have to look at the month that the commodity will be harvested or most likely harvested to determine which month we're looking at, what price we're looking at to set that price for the policy. Um, we will not allow for any kind of premium price that's put in for storing the commodity after harvest. So we'll have to take that out of any pricing mechanism. Um, and then at the time the expected value is determined, of course, which we already said. So, for example, if the price is set in the fall and then we're setting up the policy in the spring and those prices have gone out, we won't agree to use that FCIC price in those situations. The price has to be recorded on the expected yield and value document certification worksheet, and then also transferred over to the I-4, which we'll get into here a little bit. Um, All right. So the expected value of the commodity is the price the insured can expect to receive when the commodity is harvested and based on the following of sources. The first one to look at is contract. If the commodity is going to be contracted, we can use the contract for that amount of production that is under the contract. The contract has to be a fully executed contract, so both the buyer and the seller have to sign that contract before we can use it. And then it's our policy not to use contract pricing until we actually have that contract in hand. So sometimes people put down contract and use a contract price that they think it's going to be. We can't use that up front. So we have to wait until we actually have that contract. And that contract can come in at any time. If the commodity is produced and sold during the current insurance period prior to reporting your I-4, it'll be the actual price that you received. Probably don't run into many of these, but in the South, if you have a commodity that's actually produced and sold, harvested and sold prior to the policy inception, you're going to use the actual price received. If the commodity is not under a marketing contract to be sold at a specific price and it has not been sold during the insurance period prior to the I-4 being completed, then use the price that the AIP comes from the following sources. There is no order of priority now, like there used to be in the past, but these are different sources that we can use. So, prices reported by the Ag Marketing Service through their market news reports, National Ag Statistics Service prices, um, Economic Research Service prices, or any other government agency for the commodity in the area where the application and where they normally sell the commodity. Prices that represent open market sales by first handlers, shipping point prices, those generally include post-production costs that need to be removed. So, for example, the AMS price for a specific variety of apples is $17 a box, but there's post-production expenses and packing charges that amount to $12 a box. We're going to be going with the net price that the producer receives, which in this example is $5 a box. The FCIC published price or other price used to determine the insurance guarantee for an FCI reinsured policy, less the local basis, which we already talked about, where the insured normally sells the commodity. These prices may include post-production costs that must be removed. Example would be potatoes, where the price is $15 per hundredweight, but post-production is $5. So the net price would be $10 in this example. This price is not really applicable to what potatoes are doing right now. Yeah, it's going to be an issue with potatoes this year because the prices farmers are receiving right now are really low. Another example here is an example on apples where the FCI price is $37.95. You have to take into account packing costs. You also have to take into account pack outs, and then convert that to a net price received by the producer. We can also look at current local market prices, cash bid prices for the commodity in the local area for the month of harvest. An average new crop price offered by at least 2 commercial buyers, one selected by the farmer and one selected by the company. Prices from reliable disinterested third-party sources such as a commodity broker, crush district, packer, processor, or marketing co-op that we approve. And these prices may include post-production costs that must be removed. Another thing we can look at is NAP prices. We gather up all the NAP prices across the country, and that can be another price source that we can use. This is just kind of a little slide that shows us how we come up with grain pricing using the local basis. The futures price in this example is $5.89 for October harvest. There's a 25-cent basis, so the cash price is the difference, and that will be the price that we would use. If they normally harvest in November, you would use the November price. So it's the month of harvest that you want to use to set that price. And these are just some definitions. The futures price is the price from the actual marketing trade exchange. The basis is the difference between the futures price and the cash price, set by the local elevator. Cash price is made up of the difference. And then there's nearby or spot prices, new crop or harvest delivery prices. And so those are, we just want to use the cash price for the expected value of the commodity based on those markets. The last pricing mechanism that's in that list is using the 3-year average for that producer. This is the one that if we got no other markets or no other price that we can come up with, we could use a 3-year average. Again, the producer has to have records to support that 3-year average. And then we also have to look at that average based on local markets and trends. So over the last 3 years, that price has been trending down a bunch. We'll have to adjust that price down from their 3-year average. So again, it's important that the insured has to have those supporting records, and we may ask for those records to approve a 3-year average. Expected values must be reasonable, realistic, and consistent with available market information, supported by verifiable records or direct marketing sales records. Take into account current local market cycles and trends, which I just talked about. Exclude any post-production expenses, but include any market readiness operation expenses. For commodities that were purchased for resale, exclude the cost of the commodity. It's just the net gain that you're getting from that purchase for resale. And if you're vertically integrated, those prices must be consistent with other operations that are not vertically integrated. If the commodity is not under a marketing contract to be sold at a specific price, has not been sold during the insurance period or prior to the I-4 being completed, and no acceptable price source exists, then we're going to have to use 0 as the expected value for that commodity. Hopefully we don't have too many of those. This just talks about direct marketing and combined markets. So direct marketing is basically when you're not going through a third party to sell your commodity. You're selling your commodity at a farmer's market or a U-Pick or a roadside stand. That is direct marketing of the commodity. Most of the time, you're going to see this more on or less on the whole farm policy and more on the micro farm. And then direct marketing records are those contemporaneous records that document the sale of the commodities through direct marketing. If the insured sells the commodity through direct marketing, they must provide those records used to determine their allowable revenue on their Schedule F. And then combined direct marketing is when you have 2 or more commodities that you sell as a single commodity at that farmer's market or at that U-Pick sales. And then you would report that as the commodity direct marketing. Contemporaneous records basically are daily receipts, or could be weekly or quarterly records used to substantiate the revenue reported on farm tax forms. If the insured sells commodities through direct marketing or is insured under the microfarm provisions, the records used to determine taxes paid on the Schedule F farm must be provided to the AIP. Those direct marketing records must contain the insured's name, the date, the name of the market they were sold at, total cash receipts, and then listed names of the commodities sold. This is just kind of how it's filled out to come up with your expected yield and expected value. For direct marketed commodities is not considered a combined marketing commodity records. They have to include the amount of the commodity taken to market, the amount of the commodity returned from the market, the amount of the commodity sold, the prices per commodity sold on the date of market, and the revenue received for each commodity. Expected value is based on the most recent 3 years, but the expected yields fall under basically the rules of MPCI, which is a 4-year build to 10. The handbook has in Exhibit 16 some good examples on direct and combined direct marketing records. The commodities that are direct marketed may be listed on the FOR under the combined direct marketing commodity. To qualify, the insured must report at least two commodities sold through direct marketing under the combined direct marketing commodity. Commodities reported as combined direct marketing are not required to have separate expected values and yields. The insured must provide the direct marketing sales records for at least the last 3 years preceding the policy year, including the lag year, if requested by the company. And that would represent a complete marketing record of all commodities on the farm operation sold through direct marketing and reported as combined direct marketing. Revenue from sources other than insurable commodities. So if they have a roadside stand and they're selling bottled water or souvenirs or jams or any kind of post-production post-production product, have to be removed when determining expected value. We're only going to be ensuring the value of the raw commodity. And then the insured must certify the total number of planted acres for the last 3 years preceding the policy year, including the lag year of all commodities sold through direct marketing. To calculate the expected value per acre, what we're going to do is determine the average number of acres over that 3-year period, the average revenue received over that 3-year period, divide that out to come up with the value per acre. Pretty straight math there. The expected value and documentation that's put in on that expected value and yield source document then is transferred over to the farm operation report. So both worksheets have to be filled out at the time of application. If the farm operation report is similar to an acreage, basically the farm operation report is the acreage report. Under a traditional federal crop insurance product, you have your I-4, which is your intended commodities, then your R-4, which is your actual revised acreage to what you actually did plant. And then there's a third part, which is the final farm operation report, and we'll go through all three of those here in a sec. So the final revenue guarantee is going to be based on the lesser of your 5-year historic average off of your tax returns or the expected revenue from the farm operation report. So again, it's the lesser of those two numbers. Again, it's a 3-part report. You have your intended farm operation report where you're going to submit at application time what you expect to grow for the year. So if you're a calendar year filer, it's set at sales closing date. If you're a late fiscal filer, you're going to be setting it in the fall prior to the beginning of the year. Then once that's done, you go up till July, and then on July 15th, you're going to do the revised farm operation report. And that is basically where you're going to put in what you actually planted for each commodity. If you have any additional commodities that you didn't expect to grow at application time, you would add those. Also, if you have replacement commodities for something that was damaged, you'd record that there. And then if you have prevent plant, that would be recorded on the revised farm operation report. If you make changes to your farm after July 15th, you have 30 days to notify the farmer has 30 days to notify the agent of any change or any additions or any subtractions from what was done on July 15th. For example, you reported on the revised section that you intended to purchase 50 feeder cattle in August, but actually purchased 75. Then you would need to report the additional 25 cows to your agent. Then it's up to the company whether we would accept that or not. If it's not reported, any income from that additional 25 head would be included as production to count or revenue to count. And then the last part of the farm operation report is the final farm operation report. And that's due the earlier of the sales closing date for the next year. Or if it's a late fiscal filer, it's within, I think, 60 days after the end of their year, as long as that ends after the November 20th sales closing date. The purpose of the final section is just to report production and revenue for the policy year. And then the other thing is you have to, if you fail to fill out that final farm operation report, that producer would be limited to a 65% coverage level for the following year. So the I-4 is due with sales closing date. If the insured's a carryover insured, we're going to cancel the policy if they fail to give us that intended farm operation report or the completed whole farm history report as required under Section 15 of the policy. If the application is rejected, the original application, a letter explaining why the application was rejected is sent to the farmer. On the I-4, the insured is going to provide detailed information for each commodity they intend to produce or purchase for resale on their farm operation during the insurance period. Information should reflect what the farm can reasonably produce given the changes in the farm operation, availability of irrigation water, or any other changes that may affect the farm in the insured year compared to the previous years. Yields reflecting the amount of saleable production and expected revenue for each commodity with values reflecting the expected sale price in the markets where the crop is normally sold. If the insured has multiple types or practices that have different values and or yields, you need to report those separately on your I-4. For example, if you're raising 2 or 3 different varieties of apples, you want to record those separately on your I-4 because they have different prices and different yields associated with them. For the initial policy year, the insured must report any damage that occurred prior to the application being completed. This is just an example of what the farm operation report looks like. Fill this out as completely as possible. You're going to list on the intended section basically the commodity name, the code, the rate code, method of establishment, if it's acre or head or whatever, if it's animals, the expected yield, whatever that unit of measure is, expected value, and then a few years ago they added in this intended to sell percentage. So if you're raising a commodity such as alfalfa or something that can be fed to animals, any animal that you're feeding is the actual commodity, and the hay or the alfalfa is not a sold commodity. You would record what percentage you're going to feed to your animals. The next section is revised, where you would make adjustments to any changes that you made between I4 and R4. And then the final is at the end here, where you would report what you actually harvested in your final revenues. This is an example of what the intended farm operation report is. You've got a couple varieties of apples, grapes, pears, and cherries. This is how it's filled out. They're going to sell all of it. This is what they expect to get, 1,037,802. Their 5-year history was 979, 940. So the coverage is going to be based on the lesser of what they expect to get and what they've gotten over the historic period. Now that could be adjusted with different smoothing options, or but anyway, if the intended amount is higher than the 5-year average, the policy will hold to the 5-year average. If the intended is less than the 5-year average, then it will be held to the intended amount. With any perennial commodity, and this was covered earlier, a pre-acceptance worksheet needs to be completed for that, and in a lot of cases, we will go out and do a pre-acceptance inspection. If it's any new policy or transfer policy to us, we're going to do an inspection. If they have their multi-peril with us, we can use the PAW from that underlying multi-peril policy. They don't have to do it twice. And we do have functionality in our system now to copy that PAW information over from one policy to another. That's what this slide discusses. Vertically integrated producers. So a producer is considered vertically integrated if they have any related tax entities, or if they're doing any kind of adjustment to the commodity for sellable, such as turning wine grapes into wine. Those are all vertical integration situations. We have to pay a little bit more attention to those to make sure that the values that they're getting and their post-production expenses are similar to those that are not vertically integrated. We cannot use the market certification form for whole farm or micro farm. So the producer has to fill out the VIP form, the vertically integrated form. So just a reminder, you cannot use the market certification form for whole farm. A couple other reports that are important at sales closing: inventory and accounts receivable. Whole farm is only going to cover commodities produced within the insurance period. So if the producer has carryover commodities from prior years, they need to do an inventory report to record the amount of production that they have at the start of the year. Failing to do so, any commodities from a prior year that are sold during the tax year are going to be considered revenue to count. So it's very important that you ask your producers if they have carryover inventory from prior years. Because if they don't record that on the inventory report, and they do sell that commodity during the insurance period, we're going to count that production as revenue against their current year commodities. So if you're using a packet to set up your policy, and the packet contains those inventory reports, both the regular inventory and the market animal inventory report, make sure you ask your producers if they have any carryover inventory and record that on there. If they don't, make sure you write not applicable or no inventory at the start of the year. If you send it in and leave it blank, you're going to get a call from your underwriter, basically verifying for sure that you don't have any inventory, because that's very important, and we don't want to be counting old commodities against the current year guarantee. The inventory and accounts receivable is another thing we need to talk about. Those are set up at the beginning of the year. So it's whatever the beginning inventory is, or any commodity that was delivered and not paid for, as far as accounts receivable. At the start of the year, you want to record that. And all you have to do is quantify it. You don't have to value it. But it is due at the time of application. If the insured doesn't submit those reports, like I said earlier, any revenue received from those commodities during the current year will be included as revenue to count at claim time. And then ending inventory is just inventory that's being carried over the next year, and that's adjusted by the claims department. If you have animals or nursery, there is a separate report. So you want to, instead of doing the regular inventory report, you want to do the market animal inventory report. Again, on the regular inventory report, all you're going to do is put down what commodities you have, the location of those commodities, whether they're in a bin or an elevator, and then whatever the amount is. This is just an example of the beginning inventory report. At the start of the year, they have a couple varieties of apples, 10,000 boxes, and 5,200. The value does not have to be done at this time. That's done later. Accounts receivable, similar to the inventory. If you've delivered a commodity to a buyer, but you haven't got paid for it yet, you want to account for that on the accounts receivable report, because when you do get paid for that, it's going to be money earned from a prior year commodity that we want to accrue out of the claim. Accounts receivable, you want that beginning report to be completed by the sales closing date, or the later the date the application is submitted, or the last day of the month in which the fiscal year begins if you're dealing with a fiscal year filer. Ending reports are completed and valued on December 31st for a calendar year filer, and the last day of the month in which the fiscal year ends for fiscal year filers. The market animal and nursery inventory report has to include a complete inventory of both breeding and market animals. So there's two sections. The upper section is for your breeding animals, so your bulls and heifers would be recorded up above, and any market animals would be recorded down below in what you're actually going to sell. The next part of the farm operation report is the revised farm operation report, and that's basically where you're going to report any changes that were made from the initial report to what was actually produced or planted on the farm. All insureds, whether you're calendar or fiscal year filer, your R4 needs to be done by July 15th. Or if you have changes that happen after you do your R4, you have 30 days to report those changes to the farm operation. And then it's up to the company whether we're going to accept those additional changes, which we usually do. If the I4 includes only perennial commodities, you can do both the I4 and the R4 at sales closing date. So you don't have to do the R4 separately. You can do it all up front. If the insured fails to timely submit an R4 or we are unable to verify the information that was submitted, we must deny any indemnity or replant payment, and the insured will still be required to pay the premium. The R4 must include commodities that were actually planted or purchased for resale, commodities that were intended to be produced or purchased for resale but will not be due to an insured cause such as prevent plant, commodities produced or purchased for resale that were not intended to be produced or purchased when the farm operation report was originally submitted, damaged commodities and the reason for the damage, commodities produced to replace commodities that were damaged or prevented from being planted, and any circumstances that will affect expected revenue, including but not limited to a renegotiated price with a buyer or changes in production or irrigation practices. If a commodity was added to the R4 that was not on the I4, at that time, we'll set the expected values for that additional commodity as of the date the R4 is submitted. The source of the expected value and yield has to be documented for that new commodity. If commodity is added to the R4 that was not listed on the I4, the R4 by the R4 date, and a late revision is allowed by us, the expected revenue should be based on the expected yields reflecting the amount of sellable production and expected values reflecting the expected sale price by the markets that where the crop will be sold. If a marketing contract becomes effective after the R4 is due, the expected value may be revised. So if they don't get their contracts until later in the year, we can always adjust to that contract price for that proportion of the production that is under contract. Just a couple things to keep in mind here. If the revised farm operation report shows the insured has exceeded the $17 million cap, their policy is not void, but they will be capped at the 17 million, and all revenue produced will be considered revenue to count. Similarly, if they have animals and they exceed the $2 million limit on animals, we're going to cap it at the 2 million, but any production or any revenue from those, the total animals will be counted as revenue to count. If they at the revised time do not meet the 2 commodity requirement for farms with potatoes, that policy will be void and no coverage provided. If they do not have the minimum 2 commodity requirement and the revenue protection plans are in place, the policy will be void. So if they end up only planting corn, they would not be eligible for coverage because the revenue is available on that policy. If they have expected value from commodities purchased for resale greater than 50% of the total expected revenue, we'll limit the coverage to 50%, but then again, we'll take all the revenue to count from all earned commodities. Reporting destroyed commodities or those prevented from planting. A reduction in approved revenue or denial of liability is not required when an intended commodity is not planted, or is due to be or is planted and then destroyed, and then a replacement commodity is put in. When a commodity is planted that's a replacement for an alternative commodity to what they intended, we're going to adjust that commodity to offset the expected revenue of the replacement commodity. So I guess a simple way to say it is if they expected to plant corn and it's worth $10,000 and they couldn't plant it due to prevent plant, and they plant soybeans, which is worth $5,000, their coverage is going to stay at the $10,000. But we'll adjust that down based on the value of the new commodity, the replacement commodity. Remember, the insured must notify us and obtain our consent before they abandon, dispose of, or destroy any damaged or undamaged insured commodities, or sell a commodity for any other reason than its intended purpose. The whole farm handbook and our checklist provide instructions on determining the quantity and expected revenue to enter in the revised farm operation report. Since RMA removed the whole expense portion of the policy, we changed those commodities that are prevented from planting to reduce them basically by what we do on the multi-peril side. So it's basically a 60% of the coverage because they don't have the expenses of growing the commodity. So there's a reduction. So this is just an example of how that works, where you have prevent plant and you get a coverage reduction. In some cases, if there's a replant, and that's all in this example here, I won't bore you with all the details, but that's a good example. It shows how you deal with prevent plant, and in some cases where a replacement commodity is planted later on. So some language was put in to address the commodity counts when intentions change during due to an insured cause of loss. So if at I4 time, they actually have 3 commodities, in this example, corn, soybeans, and wheat. And then due to an insured cause of loss, they were unable to plant the corn, but were able to plant additional soybeans later. Due to required adjustment on the R4, there are now 2 commodities and values submitted, soybeans and wheat, but the commodity count will remain at 3 based on what was put on the I4. There are replants available on whole farm. A replanted commodity is an annual commodity that is replanted on the same acreage as the first insured commodity for harvest in the same insurance period. Replanting is performing the cultural practices necessary to prepare the land and then replacing the seed or the destroyed commodity on that same acreage. Just the thing to remember is if there's an underlying policy, underlying multi-peril policy that has replant provisions, then whole farm will not pay a replant. So it's only for commodities that do not have a multi-peril policy where replants are available there. The amount of a replant is the lesser of 20% of the expected revenue for that commodity or the actual cost of replanting. Insureds have to notify the company so we can determine if it's practical to replant and give consent to replant. Those payments won't be paid until we have a revised FOR in for the year. If an insured commodity is covered under a federal policy, then whole farm will not pay a replant. This came out in 24. It's still applicable. Insured must submit verifiable records showing their actual cost of replanting within 60 days of the R4 date in order for us to pay a replant payment. Just some standard requirements on loss notices. Just like multi-peril, the insured must provide notice of loss within 72 hours of discovery that a commodity insured under the policy has been damaged and the amount of revenue could fall below their guaranteed revenue. Not required to report general market fluctuations that are not directly related to the condition or marketability of the commodities on that operation. If the insured fails to comply with any of those requirements, we'll consider any loss or portion of the commodity for which you failed to provide notice to be due to uninsured causes, and we'll apply revenue to count equal to the guarantee on that. Claim submission, farm taxes must be completed and filed with the IRS in order for us to pay a claim. Claim must be submitted within 60 days after the earlier of the date the taxes were filed or the date the farm tax forms must be provided to the IRS as specified by the IRS. They can actually file an extension and get an extension on their claim, and then we have to have that claim done no later than 60 days after the earlier the date the taxes were filed or the final extended tax due date. And then the company does have discretion to extend the claim another 180 days to come up with an actual more accurate price on the value of those commodities. All claims are done on an accrual basis. So again, the importance of the accounts receivable and the inventory reports is that any commodities that come from the prior year that are sold during the insurance year are going to be accrued out of the claim. And then any commodities at the end of the year that still aren't sold or haven't got payment for, those will be valued and added into the claim to come up with the value of the actual commodities grown for that year. Some other adjustments for claims is we're going to add indemnities, not including refund payments received from other federal insurance policies, revenue loss due to uninsured causes, any net gain from hedging, any NAP payments, those types of payments will be applied as revenue to count if it exceeds the deductible. And this is an example where that is. You've got all those payments that you've got. They amount to $35,000. Insurance deductible is $32,500. We're going to count the difference, or $2,500, as revenue to count. There is the opt out where they can opt out of getting those payments applied to their policy. Again, it's only the amount under the deductible that is not counted. Once those payments exceed the deductible of the policy, that's considered revenue to count. And then the last step in the whole farm cycle is to do the final farm operation report, and that's got to be done by the next year's sales closing date, or 60 days after the end of their insurance period if their insurance period ends after the November 20th sales closing date. They're going to record what actually occurred on the farm operation. Information is used by RMA to rate whole farm. So it's not an actual number that we use for claims purposes, but it does need to be filled out by the farmer. Again, like I said earlier, if the final farm operation report section is not provided, the insured's next year's coverage, if they stay in the whole farm program, is going to be limited to a 65% coverage level. And so this is kind of what the final farm operation report looks like. So you've got your intended section where you set up what you were intending to grow. The final, or the revised, which is what you actually do. In this case, nothing changed because it's all perennials. And then the final is what they actually produced in their final revenues. This is just a little example on the whole flow of the policy. We've got a policy in Yakima County, Washington. This is their 5-year tax history. We're going to calculate that up by simply adding them all up, dividing by 5 to come up with a 5-year average. That at that point, you're going to look at the smoothing options that were discussed earlier, the substitution, which is taking anything that's below 60% of the average and beefing up that 1 year to 60%, or excluding a year, or a cup if you're carryover insured, where policy will not drop below 90% of last year. Again, those will help bring up your 5-year average, but they do cost money. So they're additional premiums. So you need to quote it the different ways to see what the best bang for the buck is for the insured. Then we look at the projection based on the I4. And again, it's going to be the lesser of your 5-year average or what you can expect to get on the farm for the current year. So here's where we've got our 5-year average of 979,940, and the projection based on prices and yields on the I4 is 1,037,000. The coverage is going to be based on whatever coverage level they have times that the lower of the two prices, or lower the two numbers. This is just kind of an example that shows your different coverages and the premium amounts, and whether you have no options or whether you add options, where it's going to be an additional increase in premium if you select one of those options to beef up your 5-year history. And then the final revenue or actual revenue is determined through a claims process to determine what they actually produced. Taxes filed, claim worked, and to come up with the claim, you take your approved revenue times your coverage level to get your insured revenue. Then we subtract off what the actual revenue is for the year to come up with your indemnity. In this example, $108,000. And that's pretty much the end of the presentation.